Hey guys, it's Chad Larson with MLD Wealth, and this is March 2025 update of MLD Money Matters. A lot to unpack here. I kind of feel like a bit of a shock jock radio host. I got the voice for it for sure. Um, but I'm always kind of feels like sometimes I'm here to talk about what's not going great, and that's just a nature of the beast of the marketplace, where our job is to be risk managers. Our job is to look down the horizon, and in front of our faces sometimes, and analyze risks and ensure that portfolios and capitals positioned appropriately to weather of storms, which are constantly in and around us. It's a part of air travel. There's turbulence along the way. It's something we've been talking about, ad nauseum for the last 3 years. I've been effectively doing these podcasts and notes to clients and people abroad. One of the things that's maybe close to home right now, and something that we need to think about too, is we have this self-reinforcing nature within the human condition. When you're being fed a lot of negative information, it just starts to compound. Cortisol levels spike, and human beings have a reduced capacity to deal with stress as stress continues to compound. We're supposed to be breathing in oxygen and breathing out carbon dioxide. And during periods of stress, it's seemingly we get in this vicious cycle of breathing in more carbon dioxide, and creating a bit of a poisonous and toxic environment. So the news headlines are generally not sold with rainbows and butterflies, but with doom and shock and awe. And so during these periods, it's a normal reaction to get into the mindset that the glass is half empty instead of glass full. So I really caution to, take a big step back. And, it's very simple principles is, the further you step away from the chart, or the further you step back from that problem that you're facing today, or that you think is a problem, you have to remind yourself that not all things are bad. And that simple reframing around what's important, what matters, and what you can control. That is kind of where we want to live, in that Venn diagram, or that intersection between what matters and what we can control, and try to push those circles as close as we can together, and live within that middle. There's things that are going to be in all parts of our life outside of our control, but I'm going to talk about, I'll kind of set the table for things I want to talk about. Tariffs is going to dominate the theme. It is highly topical, and it's highly serious for what is going on in the world right now. So I'm going to talk about tariffs and the central theme, and really outline what they are, not just orange man bad. I really want to set the table as to what tariffs are there and implied to do, and how they could impact global economies, domestic economies, our own borders, etc. We'll talk briefly about the Russia-Ukraine thing, or it's just topical in the media right now. I do want to spend a bit of time talking about OPEC Plus and oil. I'll touch a little bit on FX, Canadian versus the US, general geopolitical overturns, and kind of get into a bit of a closing. But that's what we're up against to talk about here today. And one of the things interesting, and I can always tell during periods of spikes in volatility, it's when my inbox gets flooded by third party providers, partners, institutions, fund managers, just dropping down all of the my inbox is full of how to talk to your clients during periods of volatility, stay the course, like this is normal. It's kind of like the stewardess running down up and down the aisles when turbulence hits, reminding everyone to stay calm. And it's part and parcel. But as I sat back, and I know we're a few days into the month already, and I think I'm more consistently kind of getting this out after the first week of the month. I had a bit of an obligation to be outside of the office at the month end, and Paula, my EA, had asked me to see if I wanted to film and record the podcast 2 days before month end. And people looked around and said, no chance. It's always in the last couple of days of the month that things go crazy, and there's topics that we want to address. So here we go. So as I was going through a lot of information, and we do a lot of, research diligence and consensus reading and conversations with third parties and people that we consider partners within our business externally, of our firm, that we look to for thought leadership. There was a letter that was written by a gentleman named Richard Pilosoff, who's become a good friend of mine, and is an absolute stalwart and, titan and leader within his own vertical within the Toronto business community. He's the principal and CEO of RPIA. He's the founding partner and CEO of RPIA, one of the largest alternative asset management firms in Canada. And prior to founding RPIA, Richard spent over 25 years with RBC Capital Markets, where he served as managing director and head of global debt markets. Richard was also responsible for developing and building RBC's international capital markets platform, now with significant operations in London, Hong Kong, Sydney, and New York. RPA oversees over $15 billion of assets under management, and is an independent asset management firm that provides alternative fixed income solutions for a broad range of Canadian investors, our clients being one of them. Richard has been, and his team have been a great addition and cornerstone to our strategy of how we approach fixed income investing. So I gave that shout out to Richard and Mehul Sudra on my team, who just loves his fixed income. Was probably going to be cheering that I said the word fixed income on the phone. So here we are. But Richard wrote a letter, and I'm going to actually read it. I told Richard I was going to kind of speak to it within my podcast, and I've tempted him, and I think he's tentatively agreed to be a guest in one of the future kind of episodes. He's just incredible thought leadership and a steady hand within capital markets. So the only parts that I edited it was maybe turned down the fixed income component, because I couldn't have written a better letter if I tried, because I couldn't. This is actually one of the better letters that I've seen delivered in the marketplace, and kind of here goes it, and it's a good listen. He writes, the tariff war has officially begun, and with it comes new challenges for investors on both sides of the border. Combined with an ever-changing geopolitical landscape, we believe financial markets will remain volatile. Tariffs, predictably, will have a significant impact across the board, from monetary policy to valuations and corporate fundamentals. While there is no shortage of information in the news on how this affects consumers, I'd like to take this opportunity to explain how this impacts our approach in managing your capital. I believe to weather this storm optimally, we must balance defense and offense. Our primary objective is to generate returns for our investors by investing wisely and actively, taking advantage of mispriced opportunities across global markets. Over the past 15 years, volatility has been our intermittent companion. And as always, we aim to continue generating strong risk-adjusted returns for our investors in all market environments. Today, doing so requires rigorous stress testing, strong conviction in our positions, and the flexibility to adapt to evolving economic or geopolitical information. This is where I've kind of made this my own. So it did say at RPIA, and I'm going to say at MLD, because this aligns to how we approach things. At MLD, this is a collaborative effort, and our risk management team works side by side with our portfolio managers to perform rigorous stress tests and scenario analysis on all of our portfolios. We also individually analyze every exposure we have in our portfolios to ensure our conviction in companies in light of the many risks prevalent today. Our global focus, which has enabled us to provide ample diversification, the importance of which is clearer today more than ever. Given the environment, we are constructively and conservatively positioned across all of our strategies, and many of our portfolio holdings have made use of hedging instruments where appropriate. We remain vigilant and nimble, actively adjusting our positioning as new information comes to light or we see changes in valuations or market corrections. The reality is, times of uncertainty can often bring times of great opportunity. Hence, we have come into this period lightly positioned so that we can add exposures to the portfolios when attractive opportunities present themselves. We seem to have more pronounced dislocations across major markets this year, which has provided some excellent opportunities to add value. To close, I want you to know that my partners and I stand with you and share your apprehensions about this trade war and what it might mean for you and your family and your business. This is an undoubtedly stressful time for many. As we weather this storm together, we are proud to be in partnership with you, aligned with your values, and working diligently to help you meet your investment goals. If you'd like to discuss the current market environment or on any of our strategies and positionings, please reach out to us at any time. This is, I read it for a reason. Richard really nailed it, and it's a nice touch in from the armchair, of a leader within business. But I don't want to say the risks of tariffs should not overshadow the rewards of trends. And despite the challenges of a changing landscape posed by trade wars and tariffs, I implore clients to remember that with high quality companies held in portfolios, we can navigate times of uncertainties. And given the inconsistencies and unknown future of this trade war, we stay vigilant, but more importantly, we keep calm and we look to compound on. So I'm going to talk a little bit about Trump and tariffs and trade wars 2.0. Provide some background and answer a few questions about the potential implication of the U.S. administration's tariff policies. So, why does President Donald Trump love tariffs? President Trump is often portrayed as being transactional and unpredictable, but his economic policy framework flows from tangible principles that he has developed over decades. We believe there are four primary reasons for Trump's approach to using tariffs. Trump maintains that the U.S. has been too generous in providing non-U.S. countries with access to the American consumer and its massive defense umbrella. It's pretty hard to argue that. Trump does not need the U.S. Congress, and tariffs provide him with bargaining power while also generating revenues and incentivizing home shoring. Trump is especially partial to the International Economic Powers Act, the IEEPA of 1977, which authorizes the president to regulate international commerce after declaring a national emergency in response to an unusual and extraordinary threat to national security, foreign policy, or the U.S. economy. From the founding of the nation to the U.S. Civil War, tariffs raised about 90% of federal government's revenues. Tariffs are not new. Tariffs are a tempting source of funds, especially as President Trump and Congress negotiate over tax policy. He could make a credible case that tariffs will add over $100 billion to government coffers, which would go a long way to fund policy priorities such as reducing the corporate tax rate to 15% for companies producing in the US. So which countries, not companies, but which countries will be most affected by Trade War 2.0? During Trump's first presidential term, there was a lot more talk about tariffs than there was action, especially in the case of China. Trade War 2.0 is 80% about China. We're hearing a lot about it on our domestic borders because it affects us more because we live here. But in our view, Mexico, Canada, and Germany are also targets. As the biggest beneficiary of hyper-globalization, China has the most to lose. We expect China's economy to continue to struggle. Tariffs are likely to reduce GDP, gross domestic product growth, by over the next 12 months, and Chinese equities to keep underperforming. Next in line would be Mexico, which represents 15% of America's overall trade imbalance, just behind China's 25. 83% of Mexico's exports travel north of the border. Exports to the U.S. represent 25% of GDP for them, and Trump is determined to renegotiate the United States, Mexico, Canada, USMCA. Further, there are several vexations issues beyond conventional trade, fentanyl, undocumented immigration, for example. So, okay, what are the potential impacts of tariffs on the Canadian economy? We believe the economic impact will depend on four factors. One, the depth, the size of the tariffs. Two, breadth, the amount of goods that will face tariffs. Three, retaliation by trading partners. And four, duration, the length of time tariffs remain in place. For the U.S. economy, tariffs will be escalating costs on roughly 40% of imported goods across three major economic regions, amounting to roughly 5% of GDP. 6 months of tariffs at this level could see the economy grind to a halt. To put some figures behind this, during Trump's first term that skewed tariffs more heavily to China, the impact hit about $360 billion in imports. Today, that figure is crossing $1.3 trillion. For Canada's economy, the situation could be worse. TD's economics calculations show if tariffs are sustained for 5 to 6 months, it would officially tip the domestic economy into a recession, albeit a relatively shallow one at that point, further duration would naturally deepen the contraction. Likewise, unemployment rate could cross the 7% threshold within that 6-month period, instead of the baseline scenario from mid-December that saw it fall to 6.4. So we've been teetering for a long time. I've been telling you structurally we've been underweight Canada. I believe I'm not allowed to put my politics in the room, but Canada's an absolute mess politically. I think we've been put into a hostage situation from a retired prime minister who seemingly is not very retiree, continues to elect people and posture and populate more government positions with friendlies. And I think the Liberal Party, so I didn't plan on talking about this, but the Liberal Party, making waste, and Trudeau deciding to step down and plopping up Mark Carney. It's a smart move by the Liberals. In that, if they, and we saw Trudeau come out and attack and retaliate with response and retaliatory tariffs announced against the US, picking a fight that we cannot win, to put Canada into a scenario that could convince people that we need a stalwart like a Mark Carney, former Bank of England governor, et cetera, someone who's been through these monetary and fiscal wars before to be the leader through the next election, when they ultimately call it. So, kind of a bravo move by the Liberal Party to tilt the cameras away from Trudeau, who no one likes anymore, and try to make the choice around someone who's been proven to navigate or been at least at the table, aside from, more of a populist driven, let's get rid of Trudeau, this isn't working mantra. But that being said, I think, listen, one of the things talking about the job loss is, however, these estimations do not account for the high likelihood that governments will buffer the economic impact via financial supports to households and businesses so they can combat that at the government level. We suspect the income side of household balance sheets will fare considerably better than a typical recession period. So think of an economic recession, but not so much at a household level. Regardless of the chosen programs, retaliatory tariffs revenue collected by the Canadian government would provide a partial financial means to offset the financial obligation of support, which was also absent in prior periods. The complexity of negotiations suggests tariffs could be in place for some time, even if deal making succeeds in reducing the scope to fewer products and or the depth. What are the implications of an America First trade policy for investors? In our view, tariffs will constitute a key investment theme all the way through 2028. We expect above trend volatility in equities, interest rates, and for foreign exchange, reflecting the transition to a new global order, coinciding with the acceleration of artificial intelligence and digital trends and rising geopolitical tensions. So, as I've been talking about historical cash on the sideline, the advent of AI, a synchronized global economic recovery, all of these thematics to be bullish, now we've got a new one. We've definitely I will be talking tariffs, I am guessing, for a while. I think in our last podcast, when the Trump administration threatened tariffs and then in the last minute paused them, there was funny mock t-shirts floating around saying I survived the trade war of 2025 of one day long. That is no longer going to be the case. We're in it hopefully to win it, but we're in it for a while. So talking about the acceleration of artificial intelligence and digital trends and geopolitical tensions, to our eyes, this could be one of the more disruptive and challenging macro environments since the end of the first Cold War. Those are big things to say. So what do? Do you run and hide? But no, given this, investors should be wary of today's highly concentrated equity markets. It's something we've preached for a very long time. We believe investors can benefit from holding a more diversified portfolio across geographies and sectors while maintaining a focus on companies that generate sustainable free cash flow and are superior capital allocators. So how and how can MLD help cushion the potential impacts of tariffs and monetary and market volatility? Well, listen, our deeply knowledgeable investment team at MLD Partners have extensive experience in continuously seeking opportunities to help generate growth and income while managing risk for the long-term investor. So we offer diversified portfolios to provide a smoother ride through bumpy market cycles, and believe that staying invested for the long term will yield the best outcome for investment portfolios. So, that's a wrap up a bit on tariffs. I said I was going to talk about the Ukraine-Russia situation. I'm not going to really jump into it too much, but the current situation, albeit is very complex. Recently the U.S. has paused intelligence sharing with Ukraine, which has seen a move to pressure Ukraine into peace talks with Russia. Additionally, Trump administration has signaled that Europe must take more responsibility for its own security. He's suspended some of the assistance. I was told not to talk about the Trump Vance treatment of Zelensky in the Oval Office, but that was, in Trump style, that was a reality TV at its best. If you haven't watched it, go watch it. I'm going to let you make your own opinion of that. Let's talk a little bit about OPEC Plus and oil. Obviously, a lot of focus to our client base. We deal with clients all over the world. But by geographic bias, we do have a lot of clients in Canada, and additionally, a disproportionate amount as a representation of global population of clients in Alberta, which is an oil economy. But demand is weakening and supply is increasing. I've been telling everyone for a while I'm bullish the equities and I'm bearish the commodity. In a drill baby drill open, make America great again scenario, to you're going to see OPEC defend against market share. So this week there was announced an increase in production starting in April with an additional 138,000 barrels a day. As of the latest data, OPEC Plus produces approximately 34 million barrels per day, and this includes contributions from both OPEC members and their allies. Saudi Arabia is the largest producer within OPEC, with an average daily production around 9.6 million barrels. That's a 2023 number, and Iraq second. While the increase is approximately 0.39% on an aggregate level, that is a material increase in volumes that have contributed to a downward shift in oil prices. FX, Canada versus the US. Predicting FX rates is not for the faint of heart. We've called the US dollar right here more so because of a dislocation between, I think, strength and stability and clear outlook for our economy versus the US economy. So as we predicted, volatility would be the theme in the first part of the year, and we've nailed that. So our overexposure to the US dollar has been helpful. The Fed is unlikely to cut interest rates as non-farm payrolls have been strong. Non-farm payrolls is nerd speak to say basically the job market remains very strong in the US. Listen, general geopolitical, it's that Trump uncertainty. However, he has while he has the American businesses to please, so policy should be accommodating. While he's unlikely to grenade U.S. versus global commerce for the long period of time, there's always geopoliticals. I think, a bit of a closing message. I probably went real fast here, and I apologize for that. With all the uncertainty over the past few weeks, this quote, it was highlighted to me by Mayhul, so thank you for that. I like quotes, I like sayings, I like words. It's something that there's the power within words and what they mean, or how they even sometimes make you feel. And this is a little bit tangential. I think many of you know I have an affinity for art, and I actually find word art quite beautiful because words in themselves can elicit emotions and feelings that are different to everybody. But sayings go the same too, how they align to what you're going through personally in your own life, in your own situation. Words matter. And I think, as I've learned throughout my my adult life, and I continue to improve, when I say words matter, is that I try to choose them a little bit more carefully. They can have intended and unintended consequences, and they're razor sharp between the two of them. And not always are we given the grace to explain ourselves. So, for someone who's really paid to talk for a living most days, I do my best to choose my words. But there's a quote from a movie called Blood Diamond, in which Leonardo DiCaprio stars in, and he's a South African diamond heister, shyster, whatever. It's a great movie. But he asks the question, when is the last time the world wasn't falling apart? So it's a bit tongue in cheek, and our message remains consistent to hold the course. But volatility, stress, calamity, tragedy, all of these things that make us feel like the glass is half empty, these are constants in our life. And I think from a mind framing, from a level setting of the opportunity set, from taking pause before making rash decisions. It's prudent to be able to make decisions from a position of strength, and largely that's driven from clarity and calmness. So wanted to kind of like close in with that. And listen, as opportunities arise, we'll review and shift portfolios in line, and we've been proactively making changes in anticipation of this volatility. Our exposure into gold, or low volatility equity exposure, our positioning and moves into ex North American exposure, and equal weighting our content throughout the S&P. All of these things remain robust, and I've seen very strong performance vis-a-vis benchmarks across portfolios year to date. January was a phenomenal month. Almost a year's worth of gains can be made in 1 month, and we did. As always, corporate profits and earnings will drive investment decision over a mid-long range period of time. So all the noise aside, let's focus. There's no higher correlation to equity price than earnings per share. So let's keep an eye on the businesses and how they're doing, and leave the noise to the newspapers. So, we're going to need to consider monetary response by central banks if tariffs remain in place for a long period of time. So there'll be a slowing for all economies that's implicated, but it's not static. Central banks in this case could cut rates and stimulate economies. Time will tell. Markets have been doing better outside of North America, and unwinding some of that long-term thematic of U.S. stock market outperformance. So that is 25 minutes and I really hope it didn't feel like a rant. There's a lot of conviction, I think, with confidence and conviction, driven by a robust process in discerning information, diligencing thought leadership, and using the experience that the broader team has assembled over the last 20 plus years. I still can't believe I'm a couple months away from my 21st anniversary of being in this role in partnership with Curtis. It's amazing. I'm thankful for this position. I'm thankful for all of you that have entrusted MLD with their capital. And if you have any questions or comments or concerns, feel free to reach out to myself or any member of the team. And if there's people within your ether and your universe that are also confused or stressed out, if they're important to you, they're important to us. Introduce us and have them have a call with us to walk through how we view the marketplace and how we might be able to help them and add value. Again, thank you so much, and I look forward to speaking with many of you throughout this month, and I'll be back here next month, hopefully with less talks about tariffs, but unlikely. Have a wonderful day.